Alright guys, I'm going to make a video on different stock market ideas here. This is going to be a general overview of different types of stocks you could buy and historical data on some of the best options that you have. Okay, this is an article from MarketWatch.com. It says 8 lessons from 80 years of market history. By the way, all these articles will be in the description below this video. What do you think is the most important thing that investors do? Is it keeping your expenses low? Hiring a superstar manager? Avoid taxes? Perfect timing? They're all significant, but arguably the very most important decision is what kind of things to invest in. That's called asset allocation. According to experts, more than 90% of your ultimate investment return depends on these choices of asset classes. What you're actually buying is much more important than worrying about fees, worrying about taxes, and all this other stuff. Okay. Now the table below shows 8 decades of returns for the most important asset classes. Large cap blend stocks. That's the S&P 500. They're essentially the biggest 500 companies in the country. Large cap value stocks. Value stocks are more distressed. They're having a little bit more trouble based on the market. As we'll actually see, they're actually very helpful. Small cap blend stocks, those are small companies, and small cap value stocks. Look at the decade returns from 1930 on the top all the way to 2013. This is the last data they had. Large cap blend stocks, large cap value stocks, small cap blend stocks, and small cap value stocks. Just by glancing at these, take a guess which one historically has been the best. It was over long periods of time. It's actually the small cap value stocks. Small cap value has beaten the market in many percents of the time, of the decades. This decade, it actually came in second to last. This decade was the highest by 5%, highest by 0.2%, highest by 1.4%, highest by 1.3%, second but only 0.5% away. This one was actually third by about 2%, highest by 3%, and highest by, this is a key part here, the last one, because this is 1930 to 2013. 14.4 is the average compared to small cap blend, which is 12.7. We're looking at a 1.7 average return over a very, very long period of time. This does not mean it's going to be like this every year, but the longer you hold your stocks, the more likely you will get returns that are significantly higher in small cap value. Look at the S&P 500, 9.7%. That is the average rate of return that the S&P 500 has received in the last 83 years. Now, in a lot of the videos I said before, I was assuming a 10% return. I said maybe that's a little aggressive and you might want to be lower conservatively into 8%. However, if you just simply started young, so you have plenty of time to do it, and kept most of your money in just the S&P 500, you're going to get really close to 10%. Now, the future does not reflect the past. There's a chance that S&P 500 might be better than small cap value for quite a long period of time. However, I would want to put most of my money on the highest returning asset class, which is small cap value. So here's some important lessons from this. Measured in 10-year increments, the market was up most of the time. You see, most of these are positive numbers, very few negatives, and the negatives were not drastically smaller. Everything else besides those were positive. We have many successful decades in a row. 14, 19, 13, 9. Don't see many negatives there, right? Leading and lagging asset classes sometimes change places. This makes it hard to pick one that's always on top. Mean reversion. Sometimes the highest asset class one particular year could be one of the lowest the next year. Most consistent was small cap value stocks. Except for the 30s, every single decade was 12.5%. The rest we'll talk about in future videos. This is the S&P 500. This is this large cap blend portfolio from 1979 all the way to the max. You'll see that there are little bumps in the road. You see some little negatives here and there. This is a pretty big drop in the dot-com bubble, and there's another big drop in 2008 financial crisis and housing crisis. But in general, you see the stock market in general trends upwards. One of the biggest things I see teachers and other people do is they are not taking enough risk in their money, and then they get very small returns. So small cap value, if you go to moneychimp.com, they have a very good article on small cap value is good, but why? Total stock market in 2027 to 2005 was only 6.7%. The small cap value was 12%. When you're looking at these type of companies, large cap are big companies. Large cap growth are well-known, exciting businesses. They're trying to grow really quickly. Large cap value are well-known, but kind of boring, selling consumer goods like soaps and detergents, Procter & Gamble. Small cap growth, well, the next Microsoft's in there somewhere. It had to start from nothing, or started from very little, right? Small cap value are more unknown, boring businesses. It's like going to a garage sale. If you're a collector of certain toys and you see a toy that happens to be worth a lot more than the person thinks, and it's not a very popular toy either. Another theory why small cap does well. They're large caps. They have very big values, so a lot of people buy them. There's going to be, because of that, a lot of stocks that are correctly priced by the market. Smaller caps are smaller companies. Less people are buying shares in them. So there is a chance to have a greater amount that are underpriced, especially if they're kind of not well-known, boring businesses. I'll skip this for the next. Now there's a neat one. You can do date range. Small cap value is very good as well. There is actually a calculator that'll show you outcomes. So in 49 years, these are the random outcomes. And you can keep clicking it to see what your possible scenarios would be. You'll notice that the numbers do change frequently, but small cap value typically does best. If you go to morningstar.com, they actually show you a big grid, and you can look up any ETF or mutual fund. Those are a basket of companies, and it'll determine if it's large or small, blend or growth. So if you look at this grid, up and down is large to small, and right to left is growth to value. The number one asset class for many periods of time was a small value. Large value also does pretty well as well. You usually want to stay away or limit the amount that you have in large and small cap growth stocks because over a long period of time, they have the lowest amounts of return. I'm not saying to eliminate them completely. I think diversifying, but leaning more towards those check boxes is a pretty valid strategy for most people. Anyway, you go back to Morningstar.com. If you type in any type of stock or ETF, let's look at DLS. This is all free, by the way. You don't need the paid one. Click on the actual ETF and then click on portfolio. You're going to see the same grid, and it will conveniently tell you around what box it's in. This is DLS. This is an international small cap value fund. Look in blue here. Blue is a small value. It's pretty good in that checkbox. The yellow one is a foreign small mid value, and red is a total index return. So this particular asset class leans quite a bit in small cap value, and I own quite a bit of this one. Another one for the US is SLYV. So go to Morningstar again. SLYV. These are the US small cap values portfolio. And again, that blue box is showing that these are leaning quite a bit towards the small and the value. A few other ETFs that I would recommend to at least look at. SPHD is a large cap value. I like about this one, it also pays monthly dividends, and you get about 0.3 as of now, 0.3% dividends per month. See the blue, it's quite a bit on the value side, and it has larger companies. A few others that I own are VTWO. This is the small cap blend. So leaning a little bit more towards the growth side of the charts on the right. The blue, still pretty small, and blend. Finally, if you go to paulmerriman.com, this shows the best-in-class recommended portfolios. He tries to, his portfolio pretty much does about an equal weighting in large and small and blend and value. So it says aggressive, says 10% in all these. Here are the actual ticket symbols that have each of these funds. I'll leave the link in the description below. I'm leaning quite a bit in my portfolio towards small in value. I have about 30% in small cap value. And this is all in the US, by the way. I have about 15% in large value. And then I have about 20% in small blend. That's the US holdings. So that's 65%. The other 35% was DLS, which is another small value. It was about 20%. And then I have another one called VEA, which is more of a large blend. That's about 10%. Give or take about a few percent there. That's my total Roth IRA holdings. Again, if you have any questions, feel free to leave a comment down below or send me an email at Lance